Hello friends. Welcome back to 5th course of high school session, which is currency crosses. In this session we have below lessons. What is a currency cross pair? Why trade currency crosses? Currency crosses are trend. Why? Trade interest rate differentials. Be careful trading obscure currency crosses. How to trade fundamentals with currency crosses. How to trade a synthetic currency pair and why you probably shouldn't. Trading the euro and yen crosses. How to use currency crosses to trade the majors. How cross-currency pairs affect dollar pairs. And summary, currency crosses. So let's begin the course with first lesson. What is a currency cross pair? Back in the ancient days, if someone wanted to change currencies, they would first have to convert their currencies into US dollars, and only then could they convert their dollars into the currency they desired. For example, if a person wanted to change their UK sterling into Japanese yen, they would first have to convert their sterling into US dollars, and then convert these dollars into yen. With the invention of currency crosses, individuals can now bypass the process of converting their currencies into US dollars and simply convert it directly into their desired currency. Some examples of crosses include pound sterling to Japanese yen, euro to Japanese yen, euro to Swiss franc, and euro to pound sterling. Calculating currency cross rates. Warning, this part is a little boring, unless you like numbers. It's not difficult, but it can be kind of dry. The good news is that this section really isn't necessary anymore since most broker platforms already calculate cross rates for you. However, if you are the type that likes to know how everything works, then this section is for you. And besides, it's always good to know how things work, right? In this section, we will show you how to calculate the bid, buying price, and ask, selling price, of a currency cross. Let's say we want to find the bid/ask price for pound sterling to Japanese yen. The first thing we would do is look at the bid/ask price for both pound sterling to US dollar and US dollar to Japanese yen. Why these two pairs? Because both of them have the US dollar as their common denominator. These two pairs are called the legs of pound sterling to Japanese yen because they are the US dollar pairs associated with it. Now let's say we find the following bid/ask prices. Pound sterling to US dollar, 1.5630, bid, 1.5635, ask. US dollar to Japanese yen, 89.38, bid, 89.43, ask. To calculate the bid price for pound sterling to Japanese yen, you simply multiply the bid prices for pound sterling to US dollar and US dollar to Japanese yen. If you got 139.70, good job. Your calculator is working properly, yippee. To get the ask price for pound sterling to Japanese yen, just multiply the ask prices for pound sterling to US dollar and US dollar to Japanese yen and we get 139.82. Easy as pie. Now I'll tell you why trade currency crosses. Over 80% of the transactions in the forex market involve the US dollar. This is because the US dollar is the reserve currency in the world. You may be asking yourself, why the US dollar and not the sterling, or euro? Most agricultural and commodities such as oil are priced in US dollars. If a country needs to purchase oil or other agricultural goods, it would first have to change its currency into US dollars before being able to buy the goods. This is why many countries keep a reserve of US dollars on hand. They can make purchases much faster with greenbacks already in their pocket. Countries such as China, Japan, and Australia are examples of heavy importers of oil, and as a result, they keep huge reserves of US dollars in their central banks. In fact, China has over $3 trillion in its reserve stockpile. So what does this all have to do with trading currency crosses? Well, since most of the world is glued to the US dollar, a majority of trading speculation will be based on one question. Is the US dollar weak or strong today? This one question will affect many of the most liquid currency pairs. The majors. Pound sterling to US dollar. Euro to US dollar. US dollar to Swiss franc. US dollar to Japanese yen. The commodity pairs. Australian dollar to US dollar. US dollar to Canadian dollar. New Zealand dollar to US dollar. Notice that all of these pairs are tied to the US dollar. This doesn't give a trader many options when most of their trading decisions are based on this one speculation. You can see that by trading any of the 7 most popular currencies, you are basically taking either an anti-US dollar or pro-US dollar stance. This one speculation affects these pairs in almost the same way across the board. Conversely, in the stock market, traders have multiple companies to choose from and are not bound to one major speculation idea. With stocks, you can see that even though the overall market was positive, there are still plenty of other trading opportunities. There isn't just one kind of speculation that affects the entire basket of stocks. Currency crosses provide more trading opportunities. Instead of just looking at the 7 major dollar-based pairs, currency crosses provide more currency pairs for you to find profitable opportunities. By trading currency crosses, you give yourself more options for trading opportunities because these currencies are not bound to the US dollar, thus possibly having different price movement behaviors. So while the majority of the markets will only trade on anti-US dollar or pro-US dollar sentiments, you can find new opportunities in currency crosses. For example, all the dollar-based pairs might be trading sideways or in some uglier fashion where it would be smart to just sit on the sidelines and wait for better trade setups. But if you knew to switch your charts to look at currency crosses, you might just find trading opportunities galore. Be different. The majority of traders just trade the majors. Now you can be part of the minority that trade currency crosses. Let's move into the next lesson. Currency crosses are trend why. Since a majority of the forex market will deal with the US dollar, you can imagine that many of the news reports will cause US dollar-based currency pairs to spike. The US has the largest economy in the world, and as a result, speculators react strongly to US news reports, even if it doesn't cause a huge fundamental shift in the long run. What this means for your charts is that you will see several spikes even if there is a trend emerging. This can make it harder to spot trend or range indications. The day-to-day economic activities of the US can keep US dollar-based currencies such as euro to US dollar, above, from making smooth trends. Conversely, we can see that during the same date range, cross-currency euro to Japanese yen made a much smoother ride to the top. This was probably due to less spikes that came from US data. So as you can see, both charts showed the euro rose during the same time period, but the one without the US dollar, euro to Japanese yen, made for a much easier trade. Our resident currency cross monster Cyclopip caught 100 pips by riding euro to Japanese yen's trend. Check out how caught that move. If you're a trend following kinda dude, then currency crosses may be easier to trade than the major pairs. It will be easier for you to spot the trend and be more confident in your entry points because you know that these technical levels hold more than they do for the majors. In the next section, we'll discuss how playing with currency crosses can also allow you to take advantage of the interest rate differentials. Now that's like a cherry on top of a sundae. Let's discuss now about trade interest rate differentials. By selling currencies whose country has a lower interest rate against currencies whose country has a higher interest rate, you can profit from the interest rate differential, known as a carry trade, as well as price appreciation. That's like being able to get a frosted cupcake with sprinkles on top. That talks to you. Imagine how delicious that would taste. Currency crosses offer many pairs with high interest rate differentials that are prime for these types of trades. For example, take a look at the nice uptrend on Australian dollar to Japanese yen. If you had a long position on this pair, you would have made a hefty profit. On top of that, the interest rate differential between AUD and JPY was huge. From 2002 to 2007, the Reserve Bank of Australia had raised rates to 6.25% while the BOJ kept their rates at 0%. That means you made profits off your long position and the interest rate differential on that trade. Now that'd be an awesome cash cow right there. Later on in college, if your brain hasn't exploded with all this Forex knowledge by then, we'll teach you more about carry trade. We'll teach you which ones will work and which ones won't. We'll even teach you about a little something called risk aversion. But that's for a later lesson. Let's come to the another topic. Be careful trading obscure currency crosses. While the euro and yen crosses are the most liquid crosses, more currency crosses exist that don't even include the US dollar, euro, or the yen. We'll call these the obscure currency crosses. If we were in school, come to think of it, we actually are in school. The major pairs would be the jocks while the obscure currency crosses would be the eccentric emo kids or hipsters. That's because most Forex traders would rather hang out with the cool crowd than the obscure crosses. We're talking about really weird combinations like Australian dollar to Swiss franc, Australian dollar to New Zealand dollar, Canadian dollar to Swiss franc, and pound sterling to Swiss franc. That's why we call them obscure crosses. Trading in these pairs can be more difficult and riskier than trading euro or yen currency crosses. Since very few forex traders trade them, transaction volume is much lower, resulting in lower liquidity. Due to the illiquid markets for these crosses, their prices can become quite volatile, so being stopped out on whipsaws can become a common occurrence. Check out these screenshots of Australian dollar to Swiss franc and pound sterling to Swiss franc. You don't want to get stopped out by those nasty spikes, do you? That's why most forex traders usually put wider stops when trading these pairs. But judging from the choppy movement of obscure crosses, it would really be tough to catch a good trade on these pairs. Unless you're a currency cross guru like Cyclopip, of course. See what we mean? Also, since these currency cross pairs aren't traded too much by forex traders, the spreads on these pairs can be pretty wide. If you want to trade these currency crosses, just be ready for some wild price swings and be willing to pay the price of the massive spread. Now I will tell you how to trade fundamentals with currency crosses. If strong economic data comes out of Australia, you might want to look at buying the AUD. Your first reaction might be to buy Australian dollar to US dollar. But what if at the same time, recent data also show the United States experiencing strong economic growth? Price action of Australian dollar to US dollar may be flat. One option that you have is to match the AUD against the currency of an economy that isn't doing so well. What could you do? Thank the Forex gods for currency crosses. Let's say you did some analysis, checked the babypips.com economic calendar, shameless plug, and you notice that the Japanese economy isn't doing so good right now. What do? Of course, like any self-respecting bully, you jump all over this opportunity and go long Australian dollar to Japanese yen. In the chart above, notice the relative strength of Australian dollar to Japanese yen versus Australian dollar to US dollar. You're not limited to just these currency pairs, you could have compared AUD against Liqueur, GBP, and CAD. From there, you can look for the weakest currency to trade against. There's nothing wrong with being a bully, at least not here at the School of Pipsology. It's your job as a forex trader to take advantage of certain opportunities so that you can put some silver dollars into your piggy bank. Because of currency crosses, you now have the opportunity to match the currency of the best performing economy against that of the weakest economy without having to deal with the US dollar. How to trade a synthetic currency pair and why you probably shouldn't. Sometimes institutional forex traders can't trade certain currency crosses because they trade in such high volume that there isn't enough liquidity to execute their order. In order to execute their desired trade, they have to create a synthetic pair. How to create a synthetic currency pair? Let's say that an institutional forex trader wants to buy pound sterling to Japanese yen but can't because there isn't enough liquidity. To execute this trade, they would have to buy both pound sterling to US dollar and US dollar to Japanese yen. Earlier in this lesson, we learned that these pairs are called its legs. They are able to do this because there is plenty of liquidity in pound sterling to US dollar and US dollar to Japanese yen, which means they can make large orders. If you're a retail forex trader, and you wanted to pretend to trade like an institutional trader, then you could technically trade synthetic currency pairs as well. But it wouldn't be too smart. Ever since the great Al Gore invented the internet, technology has improved to the point now that even weird currency crosses like pound sterling to New Zealand dollar or Swiss franc to Japanese yen can now be traded on your forex broker's platform. Aside from having access to a larger menu of currency pairs to trade, the spreads would be tighter on the crosses compared to the synthetic pair you'd create. And let's not forget about margin use. Creating a synthetic currency pair requires you to open two separate positions, and each position requires its own margin. This locks up unnecessary capital in your trading account when you can simply trade the cross currency and save on margin. So unless you're trading yards, forex slang term for 1 billion units, forget synthetic currency pairs and stick to currency crosses. You will be saving yourself some pips, thanks to a tighter spread, as well as freeing up your capital so you can take on more trades. Trading the euro and yen crosses. After the US dollar, the euro and yen are the most traded currencies. And like the US dollar, the euro and yen are also held as reserve currencies by different countries. So this makes the euro and yen crosses the most liquid outside of the US dollar-based majors. Trading the euro crosses. The most popular euro crosses are euro to Japanese yen, euro to pound sterling, and euro to Swiss franc. News that affects the euro or Swiss franc will be felt more in your crosses than euro to US dollar or US dollar to Swiss franc. UK news will greatly affect euro to pound sterling. Oddly enough, US news plays a part in the movement of the euro crosses. US news makes strong moves in pound sterling to US dollar and US dollar to Swiss franc. This not only affects the price of the GBP and CHF against the USD, but it could also affect the GBP and CHF against the euro. A big move higher in the USD will tend to see a higher euro to Swiss franc and euro to pound sterling, and the same goes for the opposite direction. Confused? Okay, let's break this down. Let's say that the US shows positive economic data causing the USD to rise. This means that pound sterling to US dollar would fall, driving the price of the GBP down. At the same time, US dollar to Swiss franc would rise, also driving the price of the CHF down. The drop in GBP price would then cause euro to pound sterling to rise, since traders are selling off their GBP. The drop in CHF price would also cause euro to Swiss franc to rise, since traders are selling off their CHF. Conversely, this would also work in the opposite direction if the US showed negative economic data. Trading the yen crosses. The JPY is one of the more popular cross currencies, and it is basically traded against all of the other major currencies. Euro to Japanese yen has the highest volume of the JPY crosses according to the latest triennial central bank survey from the Bank for International Settlements. Pound sterling to Japanese yen, Australian dollar to Japanese yen, and New Zealand dollar to Japanese yen are attractive carry trade currencies because they offer the highest interest rate differentials against the JPY. When trading JPY currency cross pairs, you should always keep an eye out on the US dollar to Japanese yen. When key levels are broken or resisted on this pair, it tends to spill over into the JPY cross pairs. For example, if US dollar to Japanese yen breaks out above a key resistance area, it means that traders are selling off their JPY. This could prompt the selling of the JPY against other currencies. Therefore, you could expect to see euro to Japanese yen, pound sterling to Japanese yen, and other JPY crosses to rise as well. The Canadian dollar to Japanese yen. Over recent years, this currency cross has become very popular, becoming highly correlated with the price of oil. Canada is the second largest owner of oil reserves and has benefited from the rise of oil prices. On the other hand, Japan is heavily reliant on the importing of oil. In fact, over 99% of Japan's crude oil is imported, as it has almost no native oil reserves. These two factors have caused an 87% positive correlation between the price of oil and Canadian dollar to Japanese yen. Let's come to the another topic. How to use currency crosses to trade the majors. Even if you don't ever want to trade the currency crosses and simply stick to trading the majors, you can use crosses to help you make better forex trading decisions. Here's an example. Currency crosses can provide clues about the relative strength of each major currency pair. Let's say you see a buy signal for euro to US dollar and pound sterling to US dollar, but you can only take one trade. Which one do you take? Simply looking at your crystal ball and guessing isn't likely to result in the right answer. To find the right answer, you would look at the euro to pound sterling cross. If euro to pound sterling is trending downward, this indicates that the pound is relatively stronger than the euro at the moment. So the right answer would be to buy pound sterling to US dollar instead of euro to US dollar due to the pound's relative strength against the euro. Since the euro is weaker, relative to the pound, if it proves to strengthen against the US dollar, it is likely to strengthen less than the pound. If the US dollar weakens across the board, pound sterling to US dollar, you would make more pips since it would rally higher than euro to US dollar. So pound sterling to US dollar is the better trade. You can do this relative strength analysis on any of the major currency pairs. Know which currency cross to use. Let's say you're bearish on the US dollar. How will you trade? Can't decide whether to buy euro to US dollar or sell US dollar to Swiss franc? Look at euro to Swiss franc. Can't decide whether to buy US dollar to Swiss franc or US dollar to Japanese yen? Look at Swiss franc to Japanese yen. Can't decide whether to buy euro to US dollar or sell US dollar to Japanese yen? Look at euro to Japanese yen. Can't decide whether to buy pound sterling to US dollar or sell US dollar to Swiss franc? Look at pound sterling to Swiss franc. Can't decide whether to buy pound sterling to US dollar or sell US dollar to Japanese yen? Look at pound sterling to Japanese yen. So always remember, looking at currency cross pairs could give you an idea of the relative strength of a particular currency. How cross-currency pairs affect dollar pairs. Let's pretend the Fed announces they will raise interest rates. The market quickly starts buying the US dollar across all major currencies. Euro to US dollar and pound sterling to US dollar fall while US dollar to Swiss franc and US dollar to Japanese yen rise. You were short Euro to US dollar and were pleased to see price move in your favor, making you some pips, but right before you were about to break out the cigar, you notice your friend who was long US dollar to Japanese yen made a lot more pips than you. You're like, what's up with that, yo? You compare the charts of Euro to US dollar and US dollar to Japanese yen and see that US dollar to Japanese yen made the bigger move. It broke through a major technical resistance level and shot up 200 pips while Euro to US dollar barely shot down 100 pips and failed to break a major support level. You're thinking to yourself, if the US dollar was being bought across the board, then how come my Euro to US dollar trade looks so weak compared to my friend's US dollar to Japanese yen trade? This is due to the currency crosses. In this particular example, Euro to Japanese yen. When US dollar to Japanese yen broke through its major resistance level, red dashed line and 101.00 handle, the combination of stop losses being hit and breakout traders jumping on the bandwagon pushed it even higher. Since buying more US dollar to Japanese yen weakens the yen, this would cause Euro to Japanese yen, and possibly other yen-based pairs, to break through its major resistance level. Once again hitting stops and attracting breakout traders, pushing Euro to Japanese yen even higher. When resistance is broken, this results in stops being triggered along with breakout traders going long, pushing Euro to Japanese yen even higher. This causes the Euro to strengthen and slows down the descent of your Euro to US dollar trade. The Euro to Japanese yen cross buying acts a parachute, and this is why Euro to US dollar didn't move as much or as fast as the US dollar to Japanese yen. So even if you only trade the major currencies, cross-currency pairs still have an effect on your trades. Let's come to the summary of currency crosses. As you've learned, there are many trade opportunities presenting themselves in the Forex market other than figuring out what the greenback will do any given day. Now you know how to find them. Here are a couple of things to remember. Crosses give Forex traders more pairs to trade, which means more trading opportunities. We normally see cleaner trends and ranges on currency crosses than we do on majors. You can take advantage of interest rate differentials by trading currency crosses. Do your due diligence and analysis and match the strong currencies against the weak ones. If the pair you are looking to trade isn't available with your broker, don't worry. You know how to create a synthetic pair by simultaneously going long or short two major pairs to create one currency cross. The most popular euro crosses are the Euro to Japanese yen, Euro to pound sterling, and Euro to Swiss franc. Pound sterling to Japanese yen, Australian dollar to Japanese yen, and New Zealand dollar to Japanese yen are attractive carry trade currencies because they offer the highest interest rate differentials against the JPY. When trading obscure currency crosses, watch out for wild price swings and wider spreads. Even if you want to stick to the majors, you can make use of currency crosses to help you decide between which pairs to trade, as crosses can signal which currency is stronger. Don't forget that moves in currency cross pairs can have an effect on the majors. Last tip, please be conscientious of the pip value of the cross you are trading. Some crosses will have a higher or lower pip value than the majors. This information is good to know for your risk analysis. So, on the days you may not see any opportunities in the major pairs, or if you want to avoid the volatility of a US news event, check out some of the currency crosses. You may never know what you may find. So you see, currency crosses aren't just for weirdos like Cyclopip. If you want to talk to your fellow Forex traders who also play the crosses, our Currency Crosses forums is the place to be. So friends, this course is completed here. In next video we will start a last course of high school session, which is multiple time frame analysis. So stay tuned.